Hi everyone, Cameron Hamilton and Ballast here with Frank Yoswick, and we are here to talk about financial planning for the end of the year, beginning of next year. So we're filming this on October 4th. Happy birthday, Ruby. It's my daughter's 3rd birthday, and we're officially into the 4th quarter. So we thought it'd be good to look at the end of the year, think about next year. What do we need to make sure we're doing? What is going through our minds when we're speaking with clients. So we'll start with a few general tips, some tips for people who are working or retired or kind of more those ages, and then wrap up with some things about giving for the year.
Sounds great.
So Frank, I want to start with probably the most common conversation I've been having this year is let's talk about cash. So we are in a environment where rates have gone up, over 4% last year. We're getting yield inside of treasuries and even money markets and CDs that we haven't been able to get in a decade or more. So we've been working with a lot of clients, making sure they're getting yield off of cash that they may not be investing for the long term right now. I want to make sure that we're engaging anyone who either we're in a situation like that, or maybe there's other cash out there, or maybe we're thinking about, do we need to change the duration on this because the yield curve has been inverted, but it's kind of flattening right now because long-term rates are coming up. So, if we've been rolling these 6-month decisions for you this year, do we need to think about, could this be, a 5-year treasury? So those are some conversations I'm going to be having before the end of the year with people. Yep. The other thing I always want to make sure we do is think about taxes before it's time to file taxes. So, we're engaging with the CPAs right now. So, if it's last year, this year, next year are all the same, you have a salary and not much change. There's not a ton of planning that's not market dependent, but we have so many clients who, bigger income this year, one spouse isn't working or looking towards retiring. There's changes that are going to be made across tax year. So it might be time to recognize income, not recognize income. So that gets into Roth conversions, accelerating contributions, giving, all that. So let's think about this year as it relates to other years and loop in your CPA if we need to help us make good decisions.
Yeah, I think Roth conversions is a great point to make here in this situation. When you're looking at a year where maybe income is down as compared to other years, great time to be making Roth conversions, or at least thinking about doing it. In the state of Kentucky, under current law, every taxpayer can take $31,110. The first $31,110 for each taxpayer is Kentucky state tax free. So that can be a Roth conversion of that amount where you're not paying Kentucky state tax on it. So, when we're looking at tax planning and looking at what the markets have done, some areas of the markets are up and some areas are down. So the S&P on the year is up about 10-11%. But the equal weight S&P is actually down a little bit, and the Dow has just gone negative on the year. So there are areas where you can still get good value of converting assets to Roth, and that fits in perfectly with tax planning for the end of the year. I'm also, with that, thinking about tax harvesting for the year.
Right.
So I want to be looking at, does it make sense if you have a high income year? Does it make sense to start taking some tax losses to offset some of those gains in other areas? And
this year it seems like more than several of the past years, you got things that are on both ends of the spectrum.
Exactly.
So we may be giving gains or recognizing losses right now.
Exactly. Yeah, this is a great year to be able to kind of get in it and take some of the gains off the table and offset it with losses in other areas of the portfolio. So switching gears here a little bit, again, it is October, so that is, of course, getting into the open enrollment period. So for everyone who still is working, this is going to be the time of year to look into open enrollment, make sure you've got the right health care, and anyone who's on the health care exchange, November 1st starts that open enrollment period. So you want to be looking to make sure that you've got the right health care set up for you. If you wanted to make a change, now's the time to start looking at that. Also, getting towards this time of the year, we're looking at FSA and HSA accounts. So remember, everyone, the FSA, use it or lose it. So if you're coming up on the end of the year and you haven't used those funds, maybe try to get those doctor's appointments in before the end of your plan year. You want to make sure you use all those funds before you lose them over the next plan year. An HSA as well, you got to make sure that you've got a high deductible health plan in order to have an HSA account. And then keep in mind you've got to have that for all 12 months of the year to be able to make the full contribution. got to make sure that you're doing either your individual or your family contribution, depending on what your plan is. And then a lot of people may not realize this. So with the HSA, you can keep the funds year to year, but a lot of people may not realize that you can't have an HSA and an FSA so long as the FSA is a dependent care FSA. So this is the time of the year to be looking into that, making sure that you've got set up what you need and what fits well for your situation.
Yeah, luckily with daycare costs, I made sure to use my whole FSA, months ago. So we're going to do
exactly.
that.
Yeah, perfect.
Yeah.
That's a good way to make sure that you use it or lose it. Yeah. Thank you for the little kids and the daycare costs. Another thing to be looking at this time of the year is qualified retirement account contributions. So the amounts went up last year for this 2022 year. The contribution limit is $22,500, another $7,500 for the over 50 catch-up. Expected to go up again next year, but before those numbers are released, we want to make sure that everyone who's trying to max out for 2023, that you're getting those contributions in before the end of the calendar year. Now this would be for your 401ks, your 403bs, etc. IRAs you can do up till the tax filing deadline next year, but you want to make sure you get those other workplace retirement account contributions in before the end of the year. I'm also looking at, we were talking about the market disparity. Some things are up,
Right.
Some things are down, some things are flat. So the Dow is flat to just went negative on the year.
Mm-hmm.
If you've got other money that you're ready to put into the market, again, this is a good time to be accelerating contributions.
Right.
Sticking everything in, you're not, you haven't missed out on a bunch of gains where you're getting in late, so to speak. This is always a good time to get back in and be putting some funds to work for you.
Yeah, attractive multiples, especially on the value side. So,
Absolutely.
yeah, if we need to talk about it, give us a shout.
Yep.
One more tip on the side of people who are still working, and I'm thinking really about business owners right now. You talked about making your 401k contributions. I think about, do we need to do anything truing up pay before the end of the year? We have a lot of clients that maybe they pay themselves, some salary that is fixed throughout the year, but then in Q4, they make a big payroll contribution to true them up to some number. And so we kind of need to be thinking about next year. Do we want to consider doing a profit share on this calendar year? And if so, do we need to make an adjustment to our pay? And it's always a good time as the owner to think about, is anything changing between this year and next year? So I have a client who, probably paid themselves $100 a couple years ago, but then we wanted to max out a profit share, so we bumped it up to $160 or $170. They have an employee now, so maybe they're going to come back down on that this year. So the decisions you make now affect what we can do next year. So let's loop us in. Bookkeeper, CPA, us. However we can provide leadership, we'll help you do it. Yeah. So now let's transition to people who are more retirement age or retired. Just a couple quick hitters on them. Healthcare, if you are not on Medicaid, not on Medicare yet, if you're on the exchange, that's something that typically people need to look at annually if there's any changes in your doctors or changes in providers coming in and out of your area. You're getting a raise probably, but not as much as last year. So the Social Security cost of living, big with inflation last calendar year. This year it looks like it's closer to 3%, but something to think about as we're budgeting. 'Tis the season, require minimum distribution. So we need to make sure that if you are RMD age, or if you have an inherited IRA, we need to make sure that we get those out before the end of the year. We've been engaging, but we'll be reaching out to everyone who hasn't. They just keep changing the rules on us, Frank.
They sure do.
So
Yeah.
what is RMD age? Well, it used to be 70 and a half, then it was 72. This year, we have no one who is taking their first required minimum distribution because the new age now is 73. So if you were born in 1951, you are special. You do not have to take your RMD until next year. So if we've been having conversations with you about it's time to go, well, it's actually not. That doesn't mean that you can't take money out of your retirement plan. We actually will tell you about an opportunity that creates when we finish up with giving here. Yep.
I think one more thing to hit on with you mentioned inherited accounts.
Mm-hmm.
With the Secure Act. So any inherited accounts that you would have inherited post 2020 after the Secure Act, that new rule that came out, the 10-year rule. So the IRS guidance was a bit unclear at first, and people didn't think that they had to be taking an RMD out each year over those 10 years. They thought, okay, I just got to empty the account by the end of the 10th year. Well, actually, guidance has come out, and there's no firm rule on this, but it appears that essentially, if the person you inherited the account from had started taking RMDs you've also got to be taking RMD.
Yeah.
So there's relief for the first 2 years when the rules were very unclear. But this year, if you've got an inherited account in that situation, let's take a look at it.
I mean, for me, I don't trust that they're not going to come back and change the rules. And for most of our clients, the inherited IRA isn't the biggest part of the picture.
Sure.
So why not just take some here in Q4? So
Keep it
I'll
safe.
probably be doing that.
Keep it safe.
Yeah.
Absolutely.
Yeah.
Yeah. So again, Cameron, this time of the year, season of giving. So gifting is always on our mind. Charitable giving, family giving is always on the mind.
Yep.
This is the kind of time that if you're thinking about giving, what are the best ways that we can be giving? So I'm thinking about, for my clients that are charitably inclined, low basis giving. So if you want to give a gift to a charitable organization, if you want to give, X amount of dollars, you're much better off giving low basis stock that's highly appreciated as opposed to writing a check for that same amount of money. So you can just gift the shares directly to the organization of your choice. You won't be paying the tax on that, neither will they if they're a qualified charity. And that's a lot more efficient tax-wise than writing a check for them.
Yeah, I even had a client this week who went and said, "Can I give you stock?" And the organization was small, and they said, "No, we don't do that. We're just running it through a community foundation." So, call us if you want to get creative about the giving. We'll help you make it happen.
Great point. Yeah, we can help facilitate that. Another thing to keep in mind as well is with the standard deduction being as high as it is, about 27 and change this year, you may want to consider gift bunching. And so what this is, for example, let's say you're the kind of person that likes to give about $25,000 a year to charity. You're very charitably inclined. Well, if you do that every single year, 25 each year, you're never going to necessarily realize the tax benefit of that deduction because the standard deduction is higher. So what you do potentially is bunch gifts. So every 2 years you gift 2 years worth, so you give 50. So you get the benefit of up and above the standard deduction, and then next year you take a year off, and then 2 years down the road you gift 2 years worth again. So we're always looking for ways to help you gift in the most tax efficient manner and help getting things done for the charities and for your desires as well with that.
Yeah, and you're an expert on that. That's confusing, for a lot of people out there. So, what I just tell people is, you tell us what you want to give.
Yeah.
We'll help you optimize it.
We'll
help you with the process. We can
Absolutely.
even run it through a donor advised fund and do several years and combine it with the low basis stock. Really get creative, but we'll help you drive the ship on it.
Absolutely.
Yeah.
Great point.
So just a couple more things wrapping up with giving then. Annual exclusion gifts. So if you give to family, $16,000 per person. If you split gift, it was $32,000 last year. That's gone up to $17,000 per person this year. So if you're writing those Christmas checks, they can be $17,000 or $34,000, depending on whether you're doing it as a single person or splitting with your spouse. One thing that I'm trying to get out into the world is the minor Roth IRA. So if you're giving and you have a child or a grandchild who has income, say we're babysitting or mowing lawns or working during the summer during college, they can make a Roth IRA contribution, and that money is going to be in there hopefully 80 years. So if you give to grandkids, maybe encourage them to fund a Roth IRA. So even if they make $2,000 in the summer, say you go spend that, I'll give you $2,000. You can put it in the Roth IRA. We've helped some people do that, and that's exciting. Just thinking about what that can become, and all the money we're keeping in the family instead of the tax.
You start thinking about the compound interest of a young miner doing that over their lifetime.
Right.
That's amazing. Yeah.
Right. And then one last thing for giving. This is more for kind of the retiree age person. Qualified charitable distributions. So those are gifts we make straight from an IRA. Can't be in a 401k. So IRA straight to a charity.
Yeah.
And Frank, I think that they messed up when they were writing these, IRS regs.
I agree with you. The ages do not match up.
Yeah.
Talk about
so you can make a donation from an IRA when you're age 70 and a half, up to $100,000 per person. So it covers most any gifts you want to make. And the RMD age did not sync up with that. So as they push out RMD age to 73 and then in 10 years, age 75, we have a window here where you probably expected to be taking money out of the retirement account, but you can give it instead. So for most of our retirees who don't have a mortgage, don't have huge medical expenses, they're probably not itemizing deductions. This becomes the best place to give money.
It's a great way.
So we do more and more every year. So if you're donating significant amount of monies, or even we have people doing checkbooks, writing their $100 checks straight out of their IRAs. It's something we like helping people do because it helps optimize for them. So that's kind
Yeah.
of exciting. So, those are our tips for planning for the end of the year, thinking about next year. We'll be reaching out to you if RMD, these type of things pertain to you. But, reach out to us if you heard any ideas that you want to talk more about. We're always here to help.